Hello, welcome back to our second part of the lesson. Now next we want to look at another ratio that you can use to determine performance of a business, and this is called return on capital employed. Now this tells us how profitable a company is compared to the amount of money used. How much capital did we invest? Then you look at how profitable company is. Alright? Therefore, return on capital employed is going to be net profit divided by capital employed times 100. That gives us rate of return on capital. Now, one profitability ratio is not useful by itself. Right? What are we saying? We cannot just take the gross profit margin, then we say we can use it to make decisions. No, we cannot use the rate of return on capital employed to make decisions. We have to compare, we have to use various ratios. So we are saying you need to use all the profitability ratios and compare it with previous years of the business for you to be able to come up with a concrete decision. Now the second ratios we talked about are the liquidity ratios, and we'll start by looking at the current ratio. This one shows us how good the company is to pay off its current liabilities with its current assets. And the current ratio is simply given by current assets minus current liabilities, or current assets divided by current liabilities. You can give it as a fraction, you can give it as a ratio, or you can give it as a percentage. Then the acid test ratio is another liquidity ratio, and this measures the ability of a company to pay off its liabilities without depending on the sales of inventory. Right? So here, saying inventory refers to stock, goods that you sell. So how quick can you pay liabilities without relying on stock? That gives us the acid test ratio. So we're saying acid test ratio is equals to current assets minus stock inventory. The current liabilities, the acid test ratio is used to measure if a business is likely to survive in the future. So if you don't have a healthy acid test ratio, it means the business is not very solvent, and therefore it cannot survive long. Then you can look at the good and the bad values of these ratios. For example, the gross profit margin percentage. Right? It tells you that there is no exact value. You must compare with the competitors, businesses. You have to compare with the previous years, and you have to compare with the target set by the business. Then if you talk about the net profit margin, percentage or rate of capital investment, rate of return on capital investment as a percentage, also you can look at the good, the bad. Then the acid test ratio, saying for you to use it, it should be above 1, unless you are dealing with cash sales, in which it can be above 0.75. Right? The current ratio should be above 1.5 for the business to be sold. So it has to be at least more than 1.5 for the business to be considered safe. That means the current assets must be more than the current liabilities by more than 1.5 or 150%. Liquidity is the ability for a business to pay off its short-term debts. So if a business assets cannot be easily converted to cash, then they are illiquid or insolvent. Current assets are liquid. Having lots of stock may mean that the company might be illiquid. That means it's not liquid because inventories or stock are hard to convert to cash, we are relying on people to buy. So like for example, I have stock of goods worth 50 million, right? Then someone comes and says, I need 50,000. I have to wait to sell the stocks. If they don't have ready cash, then that current asset of mine is illiquid, yeah, which is not a healthy thing. Liquidity is very important for business, right? If they can't convert their assets into cash, they won't be able to pay their suppliers of the current liability. So that's why we are saying liquidity is very important. If a business does not have ready cash, ready assets that can be converted into cash, then they are not able to pay their suppliers current liability. Finally, say that if a business is not liquid, then not paying suppliers will force them to stop trading to pay back their debts. Now, if you have been keen, media, we had Nakumat supermarkets, right? We had Nakumat supermarket was the biggest retail store in the East African region and Central region. But it was unable to pay suppliers. It was owing suppliers more than 6.5 million shillings. Now, when the suppliers demanded for their money, the retail store could not repay. They were taken to court. They failed to supply the goods to the Nakumat chain of stores. That's why they collapsed. That was 2 years, 3 years ago. Now, as we speak, another supermarket, Tuskys, is having a similar problem. It is having liquidity problems. It is unable to pay suppliers over 3 billion shillings. What has happened? They have had to close some of their branches because they don't have the money to pay the suppliers. If you don't pay the suppliers and they refuse to supply you with the milk that you sell, they don't supply you with the bread you're supposed to sell, the sugar, what do you sell? You have to close shop because you are unable to even pay salaries to the workers. And that brings us to the end of the lesson for today.